Hi everyone, Sergio with Capsim here. I wanted to take 10 minutes of your time today to go over what I would consider are four of the most general pitfalls that I see most students fall into. The four pitfalls that I'm referring to are understanding contribution margins, looking into product design, emergence loans, what happens if you get one, how to deal with those in the aftermath, and selecting a strategy. Starting with the very first one, contribution margin. Contribution margin is, in the basic element and sense of the word, the money that is left over from each unit you sell after you pay for the production costs. What are those costs? Labor and material. Typically, if you were to pay the lowest possible cost to produce your units and you were to be able to sell them at the highest possible price, you would make a lot of money. In this game, however, customers, eh, just like in real life, they're a little bit price conscientious. They don't really like paying higher prices. So, technically speaking, the general philosophy behind tackling contribution margin is reducing some of these costs. Here's how you do it in the game. In the simulation, you can start, for example, by taking a look at the reliability of your product. Keep in mind, reliability is one of those very important elements that make up the customer buying criteria. So you want to be mindful about how important the reliability is to the customer. This actually ties really well into the product design topic. We'll go over that in just a minute. Strictly relating to costs, though, reliability is the item or is the criteria that correlates to material costs. More reliable products imply more expensive quality materials. For example, what would happen if we were to decrease the reliability of our product, pay attention to what's happening into the material cost per unit? It's going to go down significantly. Now, this is actually what you can do on a yearly basis to decrease the overall material cost of your company. Related to labor costs, the only real way that you can decrease these costs is by improving the automation on your assembly lines, on your factories. Higher automations decrease your labor cost approximately 10% for every additional point you increase this automation in range. It does require a significant upfront cash investment, so make sure you borrow money for that. And also, this will actually make your research and development times take a little bit longer. And not only that, but the actual benefits from the automation take a year around to be useful and effective into your company. So be planned to incorporate this into your decision making to improve your contribution margin. Now, let's take a look at the second pitfall that I was going to go over, which is product design. Product design is all about understanding the customer needs and understanding where the needs of you as a company match so you can provide customers the best value proposal while also making sure that you're making money in doing so. In the simulation, each of the customers will tell you precisely what they expect from your company to offer in a product, and it will also tell you the importance rating this has in each of their decision making. So, if you are to design a product that satisfies the specific needs of a specific customer, you want to rationalize how you will achieve these goals in the long run. This actually ties really well into strategy. Now, here's what it means. First, if you were to design a product that satisfied the most important needs of the low tech customer, it would imply that you need to figure out ways to lower your prices. How do you lower prices without losing money? You lower your costs. Hint, hint, contribution margin. Now, compare that to the high tech customer needs. The most important need that customers have in the high tech market, in other words, what they find value in, is that your product meets the ideal positioning expectations. They actually don't care too much about price. They're willing to pay a higher price point, as a matter of fact, if they can get their hands on the most technologically advanced product that satisfies those yearly needs. And lastly, the last thing that they care about is reliability. So, what does that tell you? What would be a good, great product design to get this done? Couple of things to keep in mind. One, making changes to your product's attributes takes time. This time will actually tell you this in this revision date. Be mindful as well that every year, every round represents a simulated year. When you make your decisions, it's January 1st, the first day of the year. So these revisions will actually not be ready until sometime in October of this year. Incorporate this in your decision making so your product design can actually fall within your sales expectations. The third and most general pitfall that I see most students fall into is an emergency loan. Technically speaking, an emergency loan is a liquidity crisis, bankruptcy. In the game, you will never go bankrupt, but you can run out of cash rapidly. When you make it to the end of the year with a deficit of cash, the simulation will give you a bailout money, a bailout loan, or an emergency loan. The typical two reasons why you incur in this emergency loan are excessive quantities of overproduced units, in other words, a lot of leftover inventory at the end of the year, and also perhaps you invested in some of this automation to improve your margins. See what I did there? And you also perhaps invested into your capacity, but you didn't borrow any money to buy all of these assets. So what happens to your cash? It goes down, it depletes, it goes flip to the negative. Here's how it looks like on a simulation report, so I can show you how to look into the report and diagnose the root source of an emergency zone and how to deal with it going forward. In the simulation report, an emergency zone will always be shown in the first section of the report, the high-level overview. If you ever see this value here, the first thing that I would encourage you to do is take a look at your financials, which is section 5. In your financials, you should look at your cash flow statement. This is where you can see where the ins and outs of cash for the year came and impacted your company. As you can see here, there's a very big red number. I can see it's red or negative because it's in parentheses, related to inventory. There's also a really big number related to plant improvements. And basically, there's no financing whatsoever. There's no selling of stocks, and there's no long term debt being issued to finance or offset some of the cost of improving your facilities. So now that you have identified where the emergency loan comes from, you want to also take a look at, well, if it's a lot of inventory, how much do you have? And incorporate that into your next year's sales forecast. If it was related to plant improvements, the first thing that you probably want to do is, if you are going to incur in more plant improvements, well, borrow money for those, sell some shares, issue some long term debt. Make what you need to do to leverage some of your asset purchases with somebody else's cash so that way you don't run out of it. Optionally, you can use current debt against the money that you owe at the end of the year if you got an emergency loan last year. So that way you can protect your company's cash flow from unexpected swings in inventory or large current debt due balances at the end of the year. There's a little bit more information about how to deal with emergency loans in the user guide. Also, you can reach out to Capsim support. Lastly, I want to talk to you a little bit about what I would consider probably the most important pitfall in the simulation, which is not really having a plan or a strategy to make your decisions. Generally speaking, strategy is actually the plan, the long term plan that you have to achieve your long term goals. What are your goals? Well, in CapsimCore, there's only five: improve your overall company's profitability, sales, stock price, and contribution margins while also avoiding a liquidity crisis, an emergency loan. In the simulation, generally speaking, you can apply two types of plans or strategies. These two types of strategies are based off of the theory of this very important guy whose name is Michael Porter. Michael Porter said something along the lines of, hey, most company corporate strategies can be categorized into two large buckets: cost leaderships or differentiation. What is a cost leader? A cost leader is the type of company that, in the long run and on a yearly basis, invests in items or tactical decisions that will decrease costs, therefore the name cost leader, and to eventually lower prices. A few examples of this, for example, would be Walmart in the retail industry. On the other hand, on the other side of the spectrum, we have differentiators. What do differentiators do? Well, they offer something different. The added value proposal to their products is perhaps great quality, great design, great awareness and accessibility, which also comes at a higher price point to customers. The things that you do on a yearly basis is what we consider to be called tactics: changing your product's price, modifying your product's design, investing into improving your plant and equipment, borrowing money, or retiring long term debt. All of these things is what we call tactics. You do those on a yearly basis. Think about them as the steps that you walk on the path to reach your goal. The path will be the strategy, and the steps will be the tactics. In CapsimCore, we actually provide you with a few different resources that you can take a look into. Starting with your dashboard page, if you go over here to the help and support menu, you can find a little bit more information in the user guide, which is this document right here. As you can see, it provides you with some very clear information on what the goal is and how to make decisions, and additional information that you need to make these decisions. Additionally, we include the six basic strategies document. What is the six basic strategies document? Well, the purpose of this document is to provide you with some outlines or guidelines to come up with your own plan to execute over the multiple simulated years or rounds that you have available to make decisions in. Going back to the talk about strategy, remember that Michael Porter said something along the lines of, hey, there are two types of strategies: cost leadership and differentiation. However, the scope of the execution of the strategy, meaning the type of markets that you will focus in, also vary. You can be a niche or a broad type of company. What does that mean? That you can be a broad differentiator or a niche differentiator. What is the difference between a niche or a broad company? Well, like I said, it's the scope of the execution of the strategy. If you're going to be a broad type of company, you will focus in retaining a presence in all market segments. In this case, there's only two. If you're going to be a niche company, you will focus your efforts in only one market segment, either the high tech or the low tech. So, which type of strategy will be best and most convenient for you to execute? That is up to you. All strategies have a chance to be successful if properly executed. Lastly, I want to leave you with a little bit of a recap on the screen so that way you know what we talked about today. I want to leave you guys with a little bit of additional information in case you ever were to have additional questions or concerns. That information can actually be found in your dashboard page. Our phone number and email is listed at the bottom of the page. Feel free to send us an email or give us a call if you have any questions or concerns related to the simulation or any of the talking points we discussed today. Additionally, if you go to help and support, there is this very cool button called Send a Support Ticket. Through Support Ticket, you can actually reach out to one of our client relationship consultants, which is our simulation expert crew, and any of us can address any concerns you have related to the simulation. I hope the contents of the video that you watched today help you make better decisions and avoid some of the pitfalls that we talked about today. But if any other questions or concerns were to come up, Captain Support is here to help. Thank you so much for taking the time to watching this video and hopefully talk to you soon.